Hello, hello, hello. My name is Troy White. I'm with Hoodoo Financial, and welcome back to our channel. Today, we have an exciting topic for you. We are going to be talking about the basics of investing for beginners. If you're new to investing and looking to get started, then you came to the right place. In this video, we're going to cover just the basics, of investing, giving you the essentials that you need to kickstart your investment journey. So, first thing, before you start investing, it's crucial for you to understand the key concepts. And I'm going to lay out a few of those today. So let's begin with the basics. Compound interest. You must understand compound interest. So first up, compound interest, it's the magic that can grow your money over time. I just looked up something Einstein made mention of compound interest. Einstein, the legendary genius, he said that compound interest is the eighth wonder of the world. He who receives it prospers. He who does not receive it pays it, something like that. And he made some other comments that it's magic and all these things, right? And it's true. You can literally lay it out mathematically, and it is amazing. So it's the compound interest is at the root of how your money snowballs. What does that mean by snowball? I don't know if you saw the cartoons back in the day. Bugs Bunny rolled the snowball down the hill, and it starts off this big, but by the time it gets to the bottom of the hill, it's enormous, giant snowball, and it rolls over Wile E. Coyote. Well, that's because the snow is picking up snow. It's picking up snow, picking up snow, picking up snow. And that's how your money grows when you have invested it and are receiving compound returns. And so when you invest your money, it earns interest or gains. Over time, these earnings generate more earnings and your investments grow exponentially. The earlier you start, the more time your investments have to compound. So start as soon as possible. So next up, we're going to talk about diversification. It's important to spread your investments across different asset classes, such as stocks, bonds, mutual funds, ETFs, real estate. The point is you're trying to reduce your risk. You heard that saying, don't put all your eggs in one basket. Why not? Because if that basket falls, all your eggs are busted. So if you had 100 eggs, put them in 100 baskets. If one basket crashed, you still have 99 eggs. That's the concept here. We want to diversify our portfolio. A well-diversified portfolio can help you protect from the impact of a single investment's poor performance, and it will increase your chances of positive returns because you diversify. And diversity could come in sectors, industry, derivatives, all of these things. These are options that you have to invest in. And so that's the next thing. Let's discuss your investment options. There are various ways to invest. Includes stocks, bonds, mutual funds, ETFs, real estate. I could keep going down that list. The more sophisticated you are as an investor, the more your investment options that are available to you, and the different options. What's the reason for having these multiple options? Because we want to take advantage of the potential for higher returns and the potential for higher returns at less risk. So those are always components that go into our investment and in our choices of the options that we're going to use. What's your risk tolerance? What's your time horizon? A lot of different things like that. So research and understand each option to make informed investment decisions. And because what's good for you is not necessarily good for me and for any other person as well. We all have different financial backgrounds, circumstances, and different understandings. So that's going to kind of dictate what we can invest in. Next up, Budgeting is crucial when it comes to investing because it's going to determine how much we can invest, right? Because before you start investing, make sure you put a budget in place. This is going to help you determine how much money you can comfortably invest without affecting your daily expenses and your emergency savings. And I re-emphasize that word, comfortably invest. And remember, never invest more than you can afford to lose. Now, this doesn't mean, this is not gambling. But what happened is, if you've invested more than you can comfortably lose, negative financial psychology is going to kick in. And I see this over and over and over and over. Most Americans buy high and sell low. And you cannot make money that way. But why would they do that? Because you invest in a stock and then you're monitoring that stock daily, all day, every day. And you're not aware of the history of stocks. Stocks are volatile assets. So one thing I can guarantee you, yes, stocks go up and they go down. But no one knows when and at what level it's going to be. So if you're a new investor and you just invested $10,000 on a stock and you're watching it every day and you see that it's going down and now your 10,000 has a value of, let's call it 8,000. What happens is most Americans panic. They think, oh, I screwed up, and they sell that stock, and now you have officially become a loser. You officially bought it high and sold it low. And what that does is over time, new investors will do that. And over and over and over, and they'll get sour on investing. They say, this doesn't work. This is, I'm losing all my money all the time, and they'll never do it again. And this is a guaranteed way for you to lose, because if you're not putting your money out there to work for you, then, it's losing money. And so this is a very negative thing, and it starts with you not investing with a comfortable amount, and because you didn't set a budget. And this next thing, you need to seek professional advice. It's beneficial, especially if you're a new investor, because what's going to happen is you're going to fall into that trap I just laid out to you. You're going to constantly buy high and sell low. The only way to make money on this planet of Earth is to buy low and sell high. Prove me wrong, please. Go ahead. All right. Get yourself a financial advisor. A financial advisor can help you understand about investing. It help you understand what your own investment goals are, what your risk tolerance is, and they can help you create a personalized investment plan that's going to align with your financial objectives. And I'm a financial advisor, portfolio manager, etc. I'm a professional that I take clients, and maybe some of you would be an ideal fit for me, and me for you. Reach out. I'll leave a link in the description below to reach out to me. But let's wrap this up. Investing can be a powerful tool to build wealth over time. I should take the word "can be" out. It is a powerful tool, and it's more than just a powerful tool. It's about the only way you're going to find success financially. You must put your money to work. And so understand the basics of compound interest, diversification. Understand what investment options are available to you. Learn to put together a budget and seek professional advice. You can get started on your investment journey with confidence if you follow those simple steps. Now, remember, investing is a long-term strategy, and it's essential to be patient, stay committed, stay consistent, and follow an investment plan. He who fails to plan plans to fail. Please like this video. Please share this video. I know you got a cousin that needs this information. Please subscribe to our channel. We are bringing this financial literacy information to you as often as possible. Thanks for watching, and we will see you in the next video. Holla.